From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, a bid comes back into bonds after a brutal week that evaporated 2023 gains in long-dated treasuries and sent a shudder through the corporate credit market. We begin with the big issue. All eyes on Wyoming.
Jackson Hole. Jackson Hole next week.
Next week, Jackson Hole.
At Jackson Hole, there's really going to be two points of focus.
It will really come down to Powell to be on message.
Don't really think that we're gonna hear a big change in narrative.
You're getting a Fed that was hawkish and raised rates very substantially.
What is the Fed ultimately looking for?
They're likely to take a look at supply-demand imbalances in labor markets
to decide how much more, if at all, they need to adjust the overnight Fed funds rate higher.
Lean into a hawkish bias still.
The FOMC participants should be looking at the last 3 months worth of data.
The Fed has done so much already in terms of delivering those hikes.
These are not going to be kind of near-term policy decisions of what they may do with rates next month.
Rate hikes at the September meeting.
Maybe the Fed doesn't need to hike.
We are not certain that the last hike is behind us.
The Fed keeping rates higher for longer.
The Fed will have to be more aggressive, raising rates higher and keeping rates higher for longer.
Joining us now, I'm thrilled to say we have Mike Contopoulos of Richard Bernstein Advisors and Mark Cabana of Bank of America. And Mark, since you're sitting next to me, I'll start with you. So we'll get to Jackson Hole, but let's start with the price action because it has been intense, to say the least. When you think about the sell-off that we've seen in 10-year, in 30-year treasuries, what would you say is the key factor driving that?
Yeah, we really think it's two things. Number one, a reassessment of the U.S. growth outlook, especially after that much stronger than expected Q2 GDP print, which is several weeks behind us, but I think still lingers in the minds of many. And then questions over the supply-demand backdrop in the Treasury market. And that supply-demand backdrop is daunting. We know there's a lot of supply. There's lots of questions about who is going to be the end buyer. And I think that reassessment of how strong the U.S. economy will ultimately be, where is the neutral rate in the economy, coupled with questions around who's going to buy the bonds, has really driven the sell-off that we have seen. And it's driven the relatively unusual bear steepening of the 2s-10s curve that we've seen over the last month or over the last few weeks.
And Mike, I'll bring that to you. When you think about the sell-off that we've seen in the longer dated debt, is it supply? Is it growth? Is it inflation? Is it all three?
Yeah, well, first of all, let me say it's an honor to be on with you, Katie, but also Mark. Mark and I used to work together at BofA, and I couldn't imagine a better person to talk about the rates market with. So, yeah, exactly.
So sweet.
We do, try to be a nice guys every now and then. Yeah, listen, I think it's a combination of factors. Everything Mark said is spot on. You have a situation where issuance has been bigger than expected, although, it's actually been pretty well absorbed. And, couple that with August illiquidity, what's going on with Japan, relaxing yield curve control just a little bit, and the expectations that might go further later this year. And then, of course, the thing that we can't hide at all from is better than expected growth. So I think the move makes a lot of sense. The question I have is how much higher can we really go? Right. I mean, as you know, Katie, on a secular basis, we've very much been in the camp that, inflation is likely going to be stubborn. We're going to be in a period of the next 3, 5, 10 years where inflation is higher than it has been for some time for a lot of different factors. And so secularly, we see higher highs and higher lows. But on a cyclical basis, I think one could argue that we're getting much closer to fair value here and that the risks are starting to skew maybe more towards lower rates from here in the near term or over the next 6 to 9 months than appreciably higher rates from here.
Well, I really like that you and Mark are friends. Unfortunately for me, you're agreeing with each other so far. But maybe if we talk levels, we'll get to a little bit of tension here. When you say where fair value is, when you look at the 10-year yield, currently we're around 4.23%. When you're thinking about fair value, what's your gut reaction, Mike, on where that is?
Yeah, I mean, I think it's generally speaking right about here. We have a model that looks at a number of different factors, leading growth indicators, inflation, the size of the Fed balance sheet, the federal funds rate. And it kind of leads us to right around this level, right around 4.25%. But to me, a lot of what we're seeing over the last month or so is very reminiscent to what we saw last year. When you had a huge spike in yields, and then of course subsequently you had a big fall of about 80 basis points shortly thereafter. There's not a lot of new information out there other than the fact that maybe a little bit of growth has come in higher than expected, but our model suggests this is right about fair value on the 10-year.
Mark, weigh in on that. Are we heading to a 5% world?
Yeah, I know. That seems to be the buzz phrase today from some of our other colleagues in research. Look, we're already at a 5% world in some parts of the rates market, certainly at the front end. From the U.S. rate strategy perspective, though, we don't think that we're headed to a 5% 10-year world.
Okay.
We do think that you're going to see rates probably want to push higher. That's where the momentum is. That's where positioning, I think, is indicating the path of least resistance will be. But we think that rates are going to keep pushing higher. The curve probably bears steepening until you see one of two things. Number one, you see signs that the U.S. economy is indeed moderating. We haven't gotten those signals yet. In fact, we've gotten signals to the contrary that indicate monetary policy is insufficiently restrictive right now. Or the second thing that we think that the market is waiting to see is some type of negative feedback from financial conditions, which tell us that, oh, wow, rates have gone far enough, and we're now seeing corporates struggle to refinance, we're now starting to see earnings get hit, or we're now starting to see de-risking in the market from investors who maybe don't think that they're being adequately compensated for being in equities or credit or any other higher risk asset, and de-risking down into higher quality and safer instruments like treasuries. So we think that that's where the market's pushing right now. Now, in terms of fair value and forecasts, look, our fair value models have 10s close to 4. Our forecasts by the end of the year have the 10-year rate at 4%. So we do indeed think we're going to hit that point where you start to see the economy moderate, where you start to see some signs that risk assets are struggling a little bit more. And we do think that it's more likely to see rates end the year lower than higher from where we are today. But you got to respect the technicals. You got to respect positioning. Positioning has been very long from the asset management community. They've been long. They've been really struggling. There's a lot of frustration in that community. And we do think that some of the more momentum-driven accounts, let's say some of the CTAs or some of the higher frequency accounts, have been in this bear steepening dynamic. And I think they're going to push it until they start to see signs of feedback, again, from the real economy or from financial conditions that say it's gone too far. Are we there yet? We don't know. We're starting to see some signs of that feedback from risk assets and into rates markets. And my question for Mike, who's much more of a credit specialist than I'll ever be, is, Mike, when is the credit market really going to care? When are we going to start to see some of that negative feedback from credit indicate to us that rates have gone high enough, that real rates in particular are high enough to start driving some of that de-risking behavior?
Mark, I think we're pretty close to that, right now. When you look at defaults in the U.S. through the first 7 months of this year, they're the highest. You've had more defaults in the first 7 months of this year than since the first 7 months of 2010, immediately following the global financial crisis. So that tells me that there is underlying credit stress here. You look at the senior loan officer survey, and it continues to tighten, right? Credit conditions are not easy. The availability of credit is not easy. All of that is bad for corporate credit. Look at real rates at nearly 2%. That's not good for corporate credit. The high yield market in particular has a little bit of an advantage. The high yield market actually has locked in lower interest rates for some time and is arguably a higher quality high yield market than it's ever been. A lot of the junk has been pushed down into the leveraged loan market, middle market leveraged loans, private credit, et cetera. And so we think the real stress on the credit side is going to be more from the floating rate portion of the market, the leveraged loans portion of the market, the private credit portion of the market. But eventually, small leads large, weak leaves perceived strong. And so you should see that bubble up. I think that could happen at any time. I don't think it's a coincidence that, you had to get through about 4% and before you saw regional bank issues. And I think, the next shoe to drop, if there is a shoe to drop, is probably going to stem from the credit side of the economy.
And Mike, to your point on leveraged loans, you've absolutely seen defaults there outpace what you're seeing in the high yield market. And I take your point that it's a higher quality junk bond market than maybe we've seen in the past. But when you look at spreads right now, just index level spreads at 390, does that seem reasonable here, or do we need to see that get above 400? Or what are you thinking?
Oh, I think absolutely it needs to get above 400. So, the best case for high yield right now, as far as I can tell, is it's a carry market. Now, carry's pretty good. I mean, the yield on high yield is 8.5%. So I think one could make a very cogent argument that, if you think, earnings are accelerating, the economy is going to do well for the next, 6 to 12 months, I don't think it's an unreasonable argument to say I'm happy to earn carry even if I lose a couple points and make 6% or 5%. It's still not bad in terms of a total return perspective, but certainly spreads need to widen. I mean, why do we earn a spread, Katie? We earn a spread to compensate you for risks, compensate you for uncertainty. Is uncertainty going up or is it going down, right? I would argue it's probably going up, whether that be rate uncertainty, whether that be economic uncertainty, whether that be default uncertainty or recovery uncertainty. I don't think it falls much from here. And by the way, even if it does, spreads at 380, 390 basis points, that's kind of getting to the narrow end of any sort of compensation at all. So even if uncertainty declines, you don't have a lot of upside from spreads. So I think you have to go higher from here. Then the question just becomes how much higher.
Guys, I'm sad to say we only have about a minute left. And Mark, since, again, you're on set right next to me, Mike, you got to come in next time. But since you're on set, I'll give you the last word. Of course, we have Jackson Hole next week. We get to hear from Jerome Powell himself. And the Fed minutes that we got this week, it seemed like the market took that to skew hawkish. When we hear from Powell next week, do you think he'll try to walk that back?
No, we think that if anything, the risks are that he does sound a little bit more hawkish again. Recent Fed speak has sounded more balanced. You heard that balance from Powell at the July press conference. You saw it in the minutes as well. And the balance that I'm referring to here is a Fed that's been more cognizant of risks that they might over-tighten now as opposed to under-tighten, given that we've seen some progress on inflation. We don't think Powell is going to sound that balanced. And we don't think that he is, primarily because the data flow since the July FOMC has been very strong, right? I mentioned that Q2 GDP print. We also had a very strong retail sales print. Up until recently, financial conditions had been easing further. So we think that he's going to reiterate the fact that the job's not done. They can't declare premature victory, and that they're going to see this through. And that will, we think, be heard from the market as a slight change in tone. Is he going to generate a major rate sell-off like he generated last year at Jackson Hole, where he was unambiguously hawkish? No, we don't think that's his intention. But we do think, given that he is speaking, he's going to probably sound less balanced, and he's going to skew slightly more hawkish than recent Fed rhetoric.
All right, well, we have just a week to wait. It's going to be an exciting one. Really enjoyed this, both of you. That is Mike Contopoulos and Mark Cabana. Thank you both so much.
Thanks for having us.
Up next, it's the auction block. Debt issuance gets a lift from crane manufacturer. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we kick things off in Europe. And it was another day with zero sales to close out the week. If you're keeping track at home, that's 8 consecutive Fridays with no deals and 4 straight weeks where market-wide volume failed to break 5 billion euros. The primary market remains subdued in the U.S. as well. Assured Guaranty, the last company to sell high-grade debt this week, boosting 5-day tally to over $13 billion. And overhead crane manufacturer Maxim Crane Works concluding its $500 million sale of 5-year high-yield notes on Thursday. That took weekly volume close to $3 billion. Meanwhile, BlackRock's Amanda Lynham weighing in on the state of corporate credit.
there's a lot of dispersion that's happening at the corporate credit level. So if you take that index level of 375 basis points of OAS in the high yield bond market, that in and of itself is tight. But if you look under the surface, half of that universe is actually trading below 300. So there's significant dispersion between the haves and the have-nots, and that's true within high yield, between high yield and loans. Certainly, as you get up into the investment grade landscape, it's a bit more resilient. But it's going to be a name of dispersion, I think, as we move through the next 12 to 18 months, and I think that will be key for corporate credit investors.
Joining us now, I'm thrilled to say we have Westwood's Adrian Helfert and Winnie Cisar of CreditSights. And Winnie, I'll start with you. Who are the haves and who are the have-nots in this market?
It's a great question, and I think that a lot of clients are trying to navigate that very carefully because some of the haves have been what you would maybe not expect in a Fed hiking cycle, where you've seen the consumer still quite resilient. So some of those higher quality or even not as high quality consumer aligned names that were issuing very high coupon debt at the height of the pandemic have performed really quite well or continued to be able to refinance some of that high coupon debt in the new issue market recently. We've also seen energy performing pretty well, just given that commodity prices are remaining quite supportive. And really the BB universe as a whole seems to be a pretty strong have. And then on the have-not side of things, telecom, media, healthcare, all those sectors have definitely come under some serious pressure this year.
Adrian, weigh in on that. Where are the opportunities right now, and what parts of the market would you stay away from?
Sure. I'd say on the haves and have-nots question, it's clear that those companies that came and issued very heavily in 2020 and 2021, where we saw elevated issuance statistics from the high yield universe, did a good job of locking in lower rates at a time when they could actually do that. Now that yields are at 8.5% on the high yield universe, you saw pretty much an issuance holiday or a borrowing holiday in 2022 as there was sticker shock. Now coming into 2023, you're seeing these companies that are providing more security on their bonds, so more collateral packages, better covenant structures. It's costing them a little bit to do that on the borrowing side, but they're getting better lending rates by doing that. So those are kind of the haves. The ones that actually locked in lower rates at a time when they could, when those markets were open because they were concerned about financial conditions dropping or rates going up, are the haves. The have-nots are those that didn't do that. And statistics for them are that we're going to see rates going higher. Some will actually benefit from this, those that actually took cash on their balance sheet because of the uncertainty. I also believe, as our partner said, around the have-nots are those that are the sectors that are in focus. Telecom, to a big degree, is in focus right now, and there's a concern around that. Some of the consumer sectors, I think, will be in the have-not sector. Interesting that airlines have done so well this year, especially in the high-grade space. They're in the haves corner.
All right, so we have a pretty nice scorecard here. I want to talk levels, and Adrian, I'll go to you on this. If you look at high yield right now, spreads are sitting around 390. Of course, we have economists tripping over themselves right now to push back their recession calls. Against that backdrop, on an index level, is 390 basis points an entry point?
I was listening to the last segment, and I really wanted to weigh in on the last segment as well with Mark and Mike. I think we're in better shape for two reasons. One is the constituency set has changed. If you look back to around 2018, 2019, around 20% of high yield bonds had security or collateral. These were secured bonds. Now we're running around 50 or 60% of that universe. So the quality is potentially a little higher. Your recovery rates are potentially a little higher. I'll bring in one other thing, which is that 390 often takes into account a risk premium or liquidity premium that is a long-term risk premium, kind of like the VIX over a long term. I certainly believe that what the Fed did in 2020 with opening up their balance sheet and buying corporate bonds onto the balance sheet reduced that longer-term risk premium. And thus, it's a little bit of a different consideration. Now, if I look back at an overall histogram of where we are on spreads, we're about the 40th percentile, so not far from average on high yield bond compensation for default risk. We have defaults going up. That doesn't make it look all that attractive, but those 8.5% yields right now in a context of an equity market that could experience pressure,
right,
very much agree with the comment of old that that's not unattractive.
Well, let's talk a little bit more about defaults, Winnie, because it was interesting. We had a report out of Fitch this week that said that the high yield default rate could be as high as 5% by the end of this year, actually. If you look in July, that rate was only about 2.8%. The reasoning for saying that was that basically you're going to see speculative grade issuers seeking to address their near-term maturities and other liquidity-related stresses. When you think about a 5% default rate, I guess, A, does that scare you? And B, is that just a natural consequence of higher interest rates?
So a 5% default rate doesn't necessarily scare me. It's also not our base case. We think that defaults will continue to rise this year, but around 3% by the end of the year and then to 4% by midway through 2024. Somewhere between 3 and 5% is a historic average for high yield, though I will say that there are very few average years for defaults. The range is much wider in terms of default spiking and then coming well below average levels. I think that to get to a 5%, you would need to see a true stagflation type scenario take hold, which would also result in the capital markets really shutting down. So far, we've seen a lot of liquidity going to high yield issuers and also to the leveraged finance universe more broadly, with money being raised for private credit funds and direct lending. So we are not particularly scared by the potential for defaults. And if you look at what current levels are pricing in, it would not say a near-term 5% default ratio.
And unfortunately, we only have about 30 seconds left. Winnie, I'll give you the last word. When you put all of that together, you think about investment grade versus high yield. Which are you more comfortable in right now?
So we're actually neutral weight or market weight, both IG and high yield. I would say we really like high yield for the carry. We do have a somewhat up in quality bias focused on double Bs and single Bs. And a lot of that is just related to the uncertainty around the direction of Treasury yields. I think that if there is the bias for yields to continue to move higher, then high yield is actually the spot you want to be in.
All right, guys, not enough time. Have to have you back soon. Really appreciate your time. That is Adrian Helfert and Winnie Cisar. Thank you both. Still ahead, the final spread, the week ahead. All eyes on Jackson Hole. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up, earnings pick up on Tuesday, Macy's, Lowe's, and Dick's Sporting Goods. Wednesday is the first 2024 GOP presidential debate, and then we have the Fed's Jackson Hole beginning on Thursday. And all eyes will be on that summit, particularly on Powell's speech. But for us, that does it for now. This was Bloomberg Real Yield, and this is Bloomberg.